Alright, hi everyone. Welcome to today's pre-market analysis brought to you by IC Markets. Right, okay, my name is Ketan Ramachandra. I'll be hosting today's session as Desmond is still on holidays and he'll be returning back from a well-deserved break in the next couple of days. I hope everyone has had a great weekend. Right. Okay, so good morning, good afternoon, and good evening from wherever you're tuning in. Just want to make sure you guys can hear me loud and clear, as well as you're able to view the screen as well. Right, do note that we are live on YouTube, streaming directly to YouTube. So please drop any questions or clarifications that you would like in the chat box as well. I just want to make sure my chat's up and running. All right. Okay, just give me a few seconds while I just make sure everything's up and running. Okay, just want to make sure audio and video is clear. All right, hi, I'm Ahmad. How are you? All right. Maybe just a quick shout out if you can see the video is clear and the audio's loud as well. All right. Hi, Marius. Hope you guys have had a good weekend and spending time with family and friends. All right. Okay. Hi, Sam. All right. Oh, yeah, and to any American viewers that are tuning in as well, today is Memorial Day. So hope you enjoy your long weekend as well. It's going to be a 3-day weekend in the United States. Okay. So where markets will be closed today. So do take note of that. It is Memorial Day on 29th of May, right? 29th of May is Memorial Day in the US, so the stock markets will be closed, bond markets will be closed. I believe futures would be operating under shorter trading hours as well. Okay, so do take note of that. But yeah, Asia and Europe will be all markets in Asia and Europe will be open today, and but of course forex markets will be open today as well. So, okay, all right. Hi Satar, hi Jamilu. Okay, all right. I think we are good to go. Loud and clear. I see your messages coming in. Thank you very much. Right. Okay. So, as of course, before we start, right, do take note of the disclaimer. Right. All the information that is presented during this webinar or on the slides is purely for marketing information. It does not constitute or construe as investment advice or investment recommendation. Please perform all due diligence before putting on any trades. And so do take note of the risk warning that comes with CFDs. They are complex instruments and come with a high risk of losing money rapidly due to leverage, right? And you could lose substantially more than your initial investment as well. Okay, here's just a brief agenda for today. We'll just start off with the key news events, some of the things that have taken place on Friday and over the weekend as well, right? We've had the PCE price index, which is an inflation data point from the US. We've also had some positive news coming out of the White House as well regarding the US debt ceiling negotiations. We'll do some analysis on the majors or any commodities as well. So do drop your questions in the chat if you have any particular instrument that you would like to see an analysis on, right? Okay, and okay, just a quick introduction of myself. Yeah, I'm your host for today. As I said, my name is Ketan Ramachandra. I'm an external analyst at Everest Fortune Group, where we've partnered with IC Markets to bring you not only this webinar but other series and topics as well. So Everest Fortune Group has been the finalist for best equity and FX research for the following years, 2019, 2020, 2021. All right. So yeah, together with Desmond and my other colleagues, we bring you a range of other topics and webinar series for exclusively for IC markets. All right, so let's just switch over to to Google Chrome. Okay, so basically over the weekend we've had some positive news coming out of the White House with regards to the US debt ceiling negotiations. Right, so basically there's the debt ceiling is a limit that on the amount of money that the US government can borrow, right? So they are very close to approaching this debt ceiling limit, and thus they have to raise the limit. So they need the Senate and the House to come to an agreement before they can pass the bill up to the White House for President Joe Biden to sign. Okay, so there's some positive news coming out of this, and so essentially the Speaker of the House, Kevin McCarthy, and President Joe Biden have reached the tentative US debt ceiling. So because of this news, I think we can expect a lot of risk on activity this week. So with regards to equity markets, they should be all spurred on by this news. So okay, we have a request from Watson as well. US 30, yes, for sure, we can look into that as well as we progress through today's webinar. Yeah, so it is going to be, I suspect there's a very strong case for a lot of risk on activities or trading or sentiment this week. So we can expect most equity markets, Asia, Europe, and the US, the major indices to push higher this week, and it's quite likely we may see gold pulling back as well, and the currency, and most probably the dollar might be a bit softer this week as well. We've had a very strong run up in the US dollar over the last 3 weeks. Okay, so one of the reasons for that is, okay, let's just look at the chart of the DXY first before we move on to why it's been pushing this increased demand for US dollars. So we all know the dollar index or DXY is a basket of currencies, trade weighted currencies that measures the value of the US dollar versus its peers. So as you can see, this is my chart of DXY on and I'm on a daily time frame. Let's just switch up to the weekly time frame just to quickly see. Okay, so as you can see, since the second week of May, we've had a very strong run up in the dollar index. Right, there's been strong demand for the US dollar due to a combination of sticky core CPI and also rising inflation expectations. Right, okay, and also on because of that, there's concerns. Not only there's core CPI concerns in the US, but also in the EU as well. We see with most of the major economies that core CPI is not falling as rapidly as the headline CPI, and is starting to be a concern for the major central banks, such as for the Federal Reserve and the ECB and Bank of England as well. Okay, so on Friday, which was the 26th of May, okay, Friday 26th of May, we had the PCE price index, which was released in the USA. PCE is the personal consumption expenditure price index. It is basically an inflation gauge, and it is the Federal Reserve's preferred measure of inflation, right? So it measures a few things such as personal income, disposable income, the expenditures, the price indices as well, on a yearly and of course monthly basis. And we have the core and the headline reading. So this is the table, the website here. Okay, so this report was for the month of April. All right, good morning, Rick, as well. Right, this latest news release was covering the data for the month of April. So if we scroll towards the bottom here, we can see that on a annualized basis, on a monthly basis, the headline PCE has increased from 0.1 to 0.4%, and the core reading has also increased from 0.3 to 0.4%. And if you look on an annualized basis or a year over year basis, the headline reading increased from 4.2 to 4%, while the core reading is also stayed elevated and increased from 4.6 to 4.7%. Right, it's easier to view this on a chart, so let's just look here. So we can go to the St. Louis uh, website, right? They have a database of economic data for the US, and here I'm looking at the headline PCE price index from 2000 all the way to 2003. So as you can see, the headline the headline PCE price index has been dropping rapidly, just like the headline CPI. But for the month of April, we can see it tick up slightly, right? So the pullback in the headline PCE index has stalled, and it potentially could stabilize, or perhaps even worse, start to rise over the next couple of months. Right. Hi, morning, Amar. Good evening, Amar. Okay, and then if you look at the core reading for the PCE, as you can see, you can compare uh, it's pretty obvious when you compare the charts. You can see that the core PCE reading has not dropped as sharply as the headline reading, right? So this core readings across the PCE price index, across the consumer price index in the US is a growing concern for Chairman Fed Chairman Jerome Powell and all the other committee members. Right, so this is a serious concern that is starting to gain traction in the US. So that is why over the last 3 weeks we've seen a really strong demand for the US dollar. Hence, we see the dollar index moving higher. We see gold prices dropping as well, because when you have a combination of higher uh, bond yields and the value of the US dollar remaining high, this works out to be very negative for the price of gold. Okay, so as you can see, this is part of the reason why we've seen a very strong demand for US dollars over the last 3 weeks. And the recent data on Friday suggests that core CPI isn't falling as rapidly as the Fed would like. Okay, and another data point coming out was the year ahead inflation expectations from the consumer sentiment that is done by consumer sentiment survey that is done by University of Michigan. So this reading for the month of April actually spiked up to 4.6%. So previously, from January to February, we had declining levels of inflation expectations, but they spiked up to 4.6% in April. And also on Friday's reading for the month of May, they stay relatively elevated as well. So if you go to Forex Factory and look at this on the chart, right? So I'm 26 May, Friday. I'm on GMT time. I've set my settings on the calendar to GMT time. So we had at 2 p.m. University of Michigan dropping its consumer sentiment index. So if you just look at the chart for the this data point, you can see since pretty much the middle of last year, the inflation expectations has been dropping pretty rapidly, but it spiked up for the month of March, and it stays relatively elevated for the month of April as well. So because of data points such as this, and also the core CPI and core PCE readings staying elevated, we've seen a very strong demand for US dollars over the last 3 weeks, right? And because of this most recent data point, I think it is quite we can expect relatively strong demand for US dollars again this week. So let's just look at now the daily chart for the dollar index to see where we are in terms of technical levels and support and resistance areas as well. Okay, so as you can see, there's a nice descending trend line here highlighted in red. Okay, we have that. So price has touched this level on Friday and seems to have exhausted around here for now temporarily. We have not, this would be the next major resistance area for the dollar index to break out of. So that's roughly at about 104.30, and we can also see there's a nice overlap in level here as well, resistance. So this we've highlighted this as an intermediate resistance level. Okay, so if price breaks out of this area between 104.30 and 104.60 or 104.70, I think it's very likely could make a push towards the first resistance, which is at 105.70. Yeah, so the case for a stronger dollar index appears to be relatively high this week again, right? But of course, there's always pullbacks that can occur along the way. So if we start to see a lot of profit taking place in the US dollar this week, the first support area would be at about 103.45. Okay, so fundamentally, the core CPI in the US and the EU is not falling as sharply as expected, and the recent PCE readings are showing a re-acceleration of inflation in both the core and headline readings. So that is going to be a concern moving forward as well. So we have the June FOMC meeting coming up in about 3 weeks, where the Federal Reserve is likely to raise interest rates again, right? They might raise it by another 25 basis points to bring it up to, I believe that would be the upper target range would then be 5.5%. Okay, so do take note of that the dollar is still very strong, right? There's a lot of demand for the US dollar, so hence all the pairs against it are going to be weak. Okay, so if you look at euro as well, it's been falling, of course, naturally, as we would expect over the last 3 weeks, as the dollar index is made up of the euro, the dollar yen, British pound, Swedish krona, Canadian dollar, right? So, and the basket consists is heavily weighted towards the euro and the Japanese yen. So yeah, I think most of you should be aware of that. So right, the euro makes up 57% of the basket, with the Japanese yen making 13%. So that brings us a total weight of 70%. So when you have the euro losing its value rapidly and you have dollar yen rising rapidly, then of course the dollar index is going to rise sharply as well. So as you can see, for the euro, it is what was previously an ascending trend line or ascending support. It broke through this level on 17th of May last week, and this level acts as a now as a ascending resistance line. It also broke through the first support at 1.0815 and is very close to the first support today, or eventually later by Friday, right, when markets closed on the last trading day of last week. So it is very close to the first support of 1.0695. So we may find a relatively strong support for the euro around this level as we start the week off, right? Then when we look at the pound, okay, in terms of resistance level, what was previously the support level at 1.0860 is now the first resistance level as well. So if we do see price break through this resistance overlap together with as well as trying to break out of the ascending trend line as well, then we could see the euro making a push towards 1.1000. Okay, For pound, all right, for pound, okay, similarly, right, so naturally when you have the euro falling, cable is going to fall as well, so the price action is very similar between the two, right? So once again, it broke through the ascending trend line. It broke through the first resistance level, and it's sort of trading in the mid range between the first resistance and first support level as well. So right now it is at about 1.2313. So do take note that the first support for cable is at about 1.2200, and the first resistance is about 1.2420. So once again, the core inflation data reading is going to set the tone for this week, and we have to see how strongly markets and investors look for US dollar demand once again. That's my, I think, only concern. Although I do think that the dollar has gained in value pretty rapidly over the last 3 weeks, and it could be time for some profit taking to take place. But because of Friday's readings as well, it seems like there could be continued demand for the fourth week for the dollar index as well. Okay, so this is, and then for dollar yen, as we expect dollar yen to be rising rapidly, right? So there's last week it has broken through the first, what was the first resistance initially at 137.65. It also broke through an intermediate resistance at about 138.90, and now it's pushing towards the first resistance at 142.11. And do take note of this Fibonacci retracement level at 61.8%. So price is potentially could rise towards this level, and I think we can expect to see some serious resistance over here, because not only is it an overlap resistance level where price has reacted off it significantly in the past since September of 2022, but also it lines up pretty well, pretty close to the 61.8% Fibonacci retracement as well. So expect if price were to reach around this 142 area, I think we can expect a lot of selling pressure to come in for the dollar yen at this around this area, right? So just looking at dollar index as well, if you just go back to the weekly chart, the last time this year where we had such a big run up in the value of the dollar index was in February, from the second week of February, right, all the way till the end of yeah, so for like 4 weeks, from second week, was it second week, sorry, from no, basically the whole of February, right? So the first week of February, for the next 4 weeks, we had very strong demand for US dollars, which actually drives up the dollar index. Okay, although the second and third week were relatively I guess a bit volatile as well. Of course, there's bound to be pullbacks as price goes up, but you could see it made a very strong move for 4 weeks. So now we've just completed 3 weeks of very strong demand for the US dollar. It's quite likely that this demand continues into the fourth week, as we've seen the PCE data to show that to show us that core inflation and headline inflation is no longer retreating rapidly, and is starting to be a real concern moving forward. Okay, so these are some of the levels we should be aware of, and also it's also important to know that the inflation data points are no longer falling as rapidly as the central banks would like them to fall. Okay, then and we also mentioned because of the debt ceiling resolution. Okay, so there was a request for that. Okay, there's also a request for the US 30, Nasdaq, WTI. Okay, sure, we'll start covering those now. Okay, so we'll start off with US 30, which is basically the Dow Jones index. Okay, so on my chart here, and the instrument that we'll be looking at for the US 30 on Dow Jones would be the DJ30 here. Okay, so I'm on a daily chart. So okay, first of all, I think it's quite obvious to see that price has sort of relatively respected this ascending trend line, right? It has bounced off this level or close to this level at towards the end of March, and right now last week it is bouncing off this level again. So this trend line has now been tested for the, I would say, probably the second time. The first time would be around in March. It's tested off this level last week, and also it aligns pretty closely to this horizontal overlap support at 32,595. So we have a relatively strong support area over here. And because we have the positive outcome, right? Let's just look at the article, right? Okay, they've reached President Biden and the Speaker of the House, Kevin McCarthy, they've reached a tentative US debt ceiling agreement. Okay, so very likely, okay, the 1st of June was the X date for the debt ceiling limit. So this was the date where the US government was literally going to run out of money and would not be able to pay social security payments, pay federal workers, US military veterans, and a whole bunch of other organizations and services that would generally be paid by them. So this was a concern that if the debt ceiling agreement was not did not produce any fruitful outcome, then it was very likely that the US government would fall into would default. Technically, they would default and then fall into a shutdown, and thereby there would be a major volatility going into this event or around this event as the US government shuts down. You can expect economic activity to contract, so hence there'll be equity markets pulling back, VIX rising, the demand for crude oil drops as well. So technically when the government shuts down, there's less economic activity, so crude prices would react negatively to this event as well. So as you can see, it is in line with Memorial Day, so just getting ahead of Memorial Day today. The President Biden and the Speaker of the House have reached a tentative deal, and this is very likely to be positive for equity markets this week and also crude as well. Okay, so let's just now come back to the Dow Jones. Okay, so do take note of the support levels here, that we have the ascending trend lines as well as the horizontal overlap support. So the next support comes in at the very close to where the Fibonacci retracement level is, the 50% Fibonacci retracement level. So the support level, the level at 31,744 is the second key support area. As we can see, price has reacted off, bounced off this level in middle of March. It also bounced off this level at the start of November last year. So we have like two major areas where price has bounced off it, and it also lines up together with the Fibonacci retracement level as well. So indicating to us that this level is it's a pretty significant support area, together with the first support at 32,600. And with the ascending trend line, we can see that between 32,600 and 32,800 we have another significant support area for the Dow Jones as well. To the upside, as we expect equity markets to open pretty strongly this week. Do note that US equity markets will not be opening on the 29th of May, as it's Memorial Day. They'll start trading on 30th of May, Tuesday, but I think we can expect the major indices in Asia and Europe to open pretty strongly on tomorrow, right? Monday, or depending on which time zone you're in. Some of us already in on Monday, 29th of May. But yeah, so I think we can expect the major indices to open pretty strongly on the 29th as well, and then followed by the US on the 30th. So to the upside, when we do a Fibonacci retracement on this down leg move here, we have the first intermediate resistance coming up at about 33,716, which also lines up pretty close as well to the 61.8% Fibonacci retracement. So I believe we'll definitely this week the Dow Jones would be making a push towards this area, and then finally if it breaks through it, it'll head up towards the first resistance at 34,262. Do take note that the deal is tentative, so although we expect risk on sentiment to kick off the week, there is a slight chance that the deal might not be formalized, right? So do take note of any potential fallout or any news headlines that are depicting a stalemate in negotiations or for the deal to completely to fall through. That would mean that the likelihood of the US falling into a technical default or going into a shutdown, government shutdown, is very possible, and we can expect naturally volatility to increase, equity markets to pull back as well. Okay, next look at the Nasdaq as well. Okay, we've got Rick asking for Nasdaq and WTI, so let's just move on to Nasdaq. The Nasdaq has been the best performing index this year, I believe. Yeah, if I'm not mistaken, it's bounced very strongly since the start of the year, led by, of course, Nvidia. Right, Nvidia, after dropping significantly for most parts of last year, it has rebounded very strongly. I think from its low of end of last year, or from the low of this end of last year, right? I think it made the low last year. I think it's rallied almost 190% or something, right? As we know, Nvidia produces or manufactures the GPUs for PCs. And what was a demand for the Nvidia GPUs during the Bitcoin boom, where price soared to all-time highs before pulling back, and now Nvidia is riding on the AI boom, right? Artificial intelligence boom, together with ChatGPT and other applications, right? So because of that, the demand for GPUs have started to pick up significantly again, and there's a lot of hype and optimism surrounding AI adoption, mainstream AI adoption, which is what has led to another surge in demand for Nvidia GPU. So that is why we are seeing a rapid rise in the share price of Nvidia. They've also had a decent earnings report last week, although their estimates were lowered for that reporting quarter, but they did beat on the earnings front and the revenue front. So that is why we've seen this big jump in the share price of Nvidia. And of course, when you have all the other major components of that index rising as well, together with Meta as well, after making a low towards the end of last year as well, has risen very rapidly. I think Meta has probably, if I'm not mistaken, has doubled in price as well, has gained 100%. So when you have all the big components of the Nasdaq rising rapidly, that's what we are seeing. That translates naturally into the index as well. So that is what is pushing the index higher this year. And so despite the Federal Reserve raising rates, bond yields have pulled back recently, and they've been ranging rather. We can look at the US 10-year bond yield as well after this and see where it is ranging between, I think it's 3.5 and 3.7% to for about 4%. So despite bond yields being historically elevated, central banks keeping interest rates high as well, the Nasdaq has actually rebounded very strongly this year, and if I'm not mistaken, it is the most is probably having the best return, year-to-date return, among all the other major indices thus far. Okay, so now let's just look at some technical levels here. So as you can see, okay, let's just zoom out maybe on the weekly chart to see when did it actually bottom. Yeah, okay, so this is the weekly chart of the Nasdaq. So you can see between October of last year and January, at the start of January this year, you could see it is roughly it formed a double bottom, like two major bottoms here, or you could even argue it's a triple bottom on a weekly chart before breaking out of uh, the overhead resistance at 12,000 and to surge higher to where we are now to break above 14,000. All right, so so as you can see, it bottomed in the last quarter of last year and early this year before making the move higher. Right, part of the reason also is as financial conditions, right? So not only do we look at Federal Reserve central bank interest rates, we also have to look at bond yields and the value of the dollar index. So typically when the value of the dollar is high, so that means the dollar index is high, your bond yields are high. These two are part of the two factors that feed into financial conditions index, right? There's two FCIs, financial conditions index, that are reported by Bloomberg and Goldman Sachs as well. So these readings were very high, or they were elevated for the second half or for most parts of last year, which is why we saw equity. Part of the reason why we saw equity markets pull back sharply, but financial conditions actually started to loosen towards the second half of last year, particularly from at the start of fourth quarter. So when you have the dollar index falling, you have bond yields falling. Generally, that creates looser financial conditions, and that is one of the factors that started the rebound for equity indices in the US. So that is why that is part of the factor. One of the factors why we've seen equity markets bottom towards the end of last year and started rising this year, because financial conditions have loosened despite the central banks keeping interest rates high, right? Okay, so this is weekly chart. Let's zoom in onto the daily. All right, so we've had this nice, so far we have this nice ascending trend line, right? Okay, so we formed the bottom at about 10,700, right? Then a triple bottom mid-October, early November, and finally early December, January as well, before breaking out. And then this trend line, ascending trend line, has been tested in March, and again in towards the end of April and early May as well. So we've had three touches of this ascending trend line, which is, let's just extend it higher all the way up towards the first support. So as you can see now, this region here between 13,650 to about 13,700 would be a very strong support area for the Nasdaq. And as debt ceiling negotiations seem to have resulted in a positive outcome thus far, I think this intermediate resistance of 14,380 is likely to be broken this week. I think we can expect, as I mentioned earlier as well, I think we can expect a lot of significant risk on sentiment in markets as we round off May and start June. So I think we're going to have a strong start to market this week as well. Okay. Okay, there's a question by Samuel as well. Yeah, we can look at gold as well. So we'll just look at Nasdaq, and then we'll switch to WTI. We'll look at crude, and then finally we can move on to gold as well. All right. So in terms of resistance levels, do take note that 14,440 is an intermediate support level, right? It served as a nice overlap here, because we can see that price has reacted often, bounced off it here in September of 2021, and it acted as a relatively decent support in January earlier this year before finally breaking through. And then now this would be the next overhead resistance, which is likely to be broken this week. Okay, and in terms of resistance, we see a nice overlap here at 15,292. So do take note And the next major significant overhead resistance for the Nasdaq after it potentially breaks through this level here for at 14,380 would be at 15,275. Yeah, so I think we can expect bullish action in across all equity indices this week. Okay, of course, this all hinges on the finalize or the formalization of the agreement, right? They've reached, the White House has reached a tentative deal, and once it's formalized, I think we can expect markets to continue to stay elevated, at least equity markets to continue to stay elevated. And actually, if the deal does fall through, hopefully not, then we can expect higher volatility to seep in, and then naturally equity markets are going to pull back as well. Okay, so this is what we have for the Nasdaq. Okay, and then we'll look at crude oil now. Okay, so just to look at oil, right? Okay, so just recently, okay, of course, in April, start of April, we had the surprise production cuts led by Saudi Arabia together with OPEC Plus members, which caused oil prices to spike higher. And after that, it started pulling back due to a combination of several factors. I'll just quickly cover those fundamental factors that drove the price of oil down. So we had a combination of higher inventory bills coming out of the US. So what do I mean by inventory bills? That means the inventory levels were increasing on a weekly basis. So when inventory levels are increasing, generally it means that demand is not as strong. And conversely, when inventory levels are falling regularly on a weekly basis, it would suggest that the demand for crude in America is strong. Plus, we also had relatively weaker PMI data and trade balance data out of China as well. As we all know, China is the second largest economy in the world, and together with its expected opening or reopening this year, there was a expectation of significant demand for crude oil coming in from China, which has not materialized. China has not opened or rebounded in the way the other economies have, like in the US and EU. So we saw PMI data not being weaker than expected. We see the latest trade balance data, which highlighted the fact that China imported much less crude oil for the previous month. I can't remember the figure exactly, but based on historical standards, they imported a much lower figure than what they would historically import on a monthly basis. So a combination of that, of the US inventory bill plus weaker data out of China, has been pushing oil prices lower. And also the debt ceiling crisis came to the forefront in May as well. So that is also another factor that was pushing down crude oil prices, right? As I mentioned earlier, if the US government were to technically default and enter a shutdown, that means a lot of economic activity is going to come to a halt. So that translates to less demand for crude oil, and hence prices fell as well. And part of the reason why now we've seen crude oil sort of stabilize and move higher is inventory bills in the US, especially last week, have started to surprise to the upside. So what do I mean by that? It means that the inventory has been drawing down more than the forecast. So that is good. That highlights stronger demand. We've also had positive news, better optimism coming out of the White House with regards to the debt ceiling negotiations over the last couple of weeks as well. So that has helped to put a support under oil prices as well. But however, I want to zoom in onto 25th of May, where the Russian oil minister, right, made a comment. He was, I think, speaking at some event or giving an interview where he made a comment where the upcoming OPEC Plus meeting, regarding the OPEC Plus meeting, where he said that the members are not likely to pursue further cuts at that meeting. Okay, so I don't have the exact date for that, but if you can Google OPEC Plus meeting, there's a meeting coming up in June. It should be in 1 or 2 weeks. So because we had that surprise cuts by OPEC Plus in April, which caused us spike in crude prices during that period. So on 25th of May, his remarks actually brought down crude prices, right? So he basically said that there's no intention for OPEC Plus to further introduce production cuts. So this is one of the reasons why we had this sharp pullback in crude prices. I believe they fell nearly 3% on that day, or perhaps even more. But now prices have sort of stabilized and are buoyed by the optimism coming out of the US with regards to the debt ceiling crisis. Okay, so a debt ceiling negotiation. Uh, so oil prices, at least from a fundamental point of view, are being supported by the higher drawdown in US inventory bills, is being supported by the optimism surrounding the tentative deal for the US debt ceiling limit. Okay, and there'll be other factors as well. We'll have to look out for other economic activity that's coming out, and also no production and no surprise announcement by OPEC or OPEC Plus as well. Okay, so in terms of support levels, we can see this horizontal support level at $70.14, right? We can see this overlap level has been acting as a support back in December of 22. It acted as a support in 15 May as well. Yes, of course, price did break through these levels in March earlier this year. But if we zoom out a little bit, okay, so this level of $70.14 would be the first immediate support level for WTI crude. And as you can see here in this overlap resistance highlighted by this red dotted line, you can see when price was ranging, right? Price was ranging between $70 and $82 a barrel from the start of December till 14th of March, right? Price was ranging between this level. So that is why it's also important to look at charts at a slightly higher time frame on a weekly and daily chart to identify major trends, right? In this case, we had sideways action, or it was range bounding, and we also can see clearly here this was a clear bullish move, a bearish move down. Okay, so we can see that price was ranging before it broke through. Okay, this reminds me why it broke through, because we had the US banking crisis, right? The regional banks, issues with the regional banks coming to the forefront, with Signature First, Silicon Valley Bank. So any banking crisis could potentially lead to systemic risk in financial markets, which in turn would lead to recession, potential recession risk. So because of that potential chain of events, we saw crude prices tanking as well, because when you have recessions in the US, it's very likely it's going to spill over to the rest of the world, and we can impact demand for crude to significantly drop as well. So that is why we saw crude oil prices break through this support at about $73.50, breaking through that support and falling hard based on the regional banking crisis. Okay, yes, so okay, and the second support is identified by this the second support level is identified by this overlap support here, where price has bounced off it in August of 21 and also in December of 2021. So it's also important to zoom out on the time frame as well, to see in history where price has reacted off certain levels, be it support or resistance. So this is how we identify strong areas or potential strong areas for support and resistance levels. Okay, and also we've also done the Fibonacci retracement as well. Okay, so we've done the Fibonacci retracement on this downward leg of the move. So we can see 50% and 61% acting as significant retracement levels. Hi Marcus, okay, I see your question as well on gold. Yes, even Samuel has that. We'll be covering this just in the next 1 or 2 minutes. All right, just give me a couple of minutes before switching to gold. Okay, so for crude WTI, 50% the retracement levels of 50 and 61.8% the potential resistance levels as well. Right, so you can see here price has reacted nicely off it on 24th of May before the Russian oil minister made his comments, causing price to fall. Okay, so we can see it is served as a relatively good support level as well on 26th of April. Price, when it was pulling back, found support around 74.50 to move higher before finally breaking through. So this 50% support, 50% Fibonacci retracement level would be one of the key areas of overhead resistance, together with this dotted line. So between 73.40 and 73.50 would be your immediate area of resistance. And if there's risk on sentiment this week, we can expect crude oil prices to go higher. And do look out for the API and EIA inventory data this week as well, because if these two data points show further increase in drawdowns in inventory levels, that is also another fundamental reason to push crude oil prices higher, and it's likely we could hit 76.90 as well, or make a push towards 76.80, 76.90. All right, so now let's move on to gold. Okay, similarly, as we know, gold prices are driven by real rates, right? The real rates are a function of bond yields, nominal bond yields, and expected inflation levels. Gold is also the price or the value of the dollar also has an impact on gold as well. So the combination of high US dollar and high bond yields is negative for gold prices, which is what we saw for most parts of 2022, right? This is the area where financial conditions were tightening. So we had rising bond yields, rising US dollar, which was creating significant headwinds for the price of gold, right? I think I mentioned this last week as well, but just to quickly highlight this for maybe viewers who are tuning in for the first time, or maybe may have missed it last week. So when we look at the monthly chart for gold, right, if you look at the monthly chart for gold, so recently, since August 2022, the region of 2050 and 2070 has been a major area of resistance. So this area, when gold prices peaked in August of 2020, they went as high as $2,070 per ounce before retreating back, and then back in March as well, as we had the combination of falling dollar, falling bond yields, and also the regional banking crisis coming to the forefront. We saw gold prices touch to 2050 per ounce again before pulling back very sharply, and again price has been rejected around this area. So do take note that there's immense selling pressure coming between 2050 and 2070 per ounce, right? It would take a serious buying pressure and a fundamental catalyst to push gold beyond 2050 and 2070. So do take note of that. There's significant selling pressure coming in within that region. Okay, so let's go back to the weekly chart now. So like I said, so between 2050 and 2070, we can see if prices come back up to this level, right? If they reverse off 1960 to come back towards 2000, and on a slightly higher or longer view, or do take note that the level of 2050 to 2070 per ounce is a major resistance area. All right, okay, now we're back on the daily chart for gold. So the instrument we're looking at is XAU USD. Okay, so this, you can see there's a nice trend line here, ascending trend line here, which has been tested once back in March, and it sort of tested it very last week as well. It's come very close. So we have this area here that is supported by a horizontal overlap and ascending trend line. together with the 50% Fibonacci retracement on this upward leg of the move. Upward move of the leg, sorry, yeah. So we have identified three indicators. We have three indicators that are highlighting that this level of 19,035 is a potential support. Price has reacted off it here in March as well before moving higher, and now it all depends on the value of the dollar, right? We've seen a significant demand for US dollar picking up over the last 3 weeks, together with rising bond yields as well. So these two factors play a part in the direction for the price of gold, and it's pulled back very strongly. So I think gold prices may find support around here, 1935, around 1935 level. We may see a slight retracement in gold prices to move towards the first resistance, 1958, okay, to about 1960 per ounce. But do take note of last week's inflation data, right? We had headline and core PCE data plus inflation expectations data as well, which suggests that inflation is not going away, and it seems to be re-accelerating, especially on the core, especially for the core reading. So that is the I would say my real concern for gold, because if we could continue to see strong demand for the US dollar this week, again this would make the fourth consecutive week of demand for the dollar, and if we see bond yields continue to stay elevated or perhaps even rise, then what appears to be a significant support area could likely be broken, right? So based on the data for on the recent inflation data, I think we may see gold prices find support here, probably retrace to move a little bit higher, but I think we could see gold prices break lower here, right? So if we break through this horizontal support and this ascending trend line, then yeah, it's very likely that we could see gold fall towards 1920, right? 1920 and probably 1900. So do take note of how markets react today to the US debt ceiling news, and also to the inflation data that came out last Friday as well. So the direction of the dollar index, or the value of the dollar, and bond yields, do take note of bond yields as well. They will give us a good direction into the price of gold. Yeah. So okay. So for me, I think because of the inflation data, I would probably be more, if you'd ask me personally, my opinion would be, I think that there's more risks to the downside for gold, but because we've had such a big selling pressures over the last 3 weeks, I think we may finally start to find support around the 1930 level. We may see profit taking coming into play as well, so we might see a relief rally in the price of gold before it starts to pull back further. All right, so just quickly look at US 10-year bond yield. So just US 10Y. Okay, right? So as you can see as well, we've seen bond yields rise very sharply. This is the US 10-year bond yield. We can see it rise from about 3.4% all the way to last week going as high as 3.8%, right? So this combination of rising bond yields together with the rising dollar index is very negative for gold prices as well. So it's important to look at both bond yields and the value of the US dollar to give us a direction for where gold could technically hit. So as you can see, since March this year, end of March this year, bond yields were ranging between 3.3% and 3.6%. And the dollar also was relatively weak during that period. So this is the period where we saw gold move higher as well. But once the strong demand for dollars started coming in, we saw the concerns around core PCE, core CPI readings coming to the forefront in the US and also in Europe. we saw bond yields started to rise rapidly together with the value of the dollar, which is what is causing gold prices to retreat significantly. So do take note of US bond yields as well when you're looking at the price of gold. Okay, so that is why between uh, March, right, March and April, we saw gold prices consolidate pullback and before going higher as well. All right, okay, I've pretty much covered everything so far. If there's any other requests, I can probably do one more. We can cover one more instrument. Anything you want to look at, a forex pair or a indices index, another index or another commodity. Otherwise, I'll just quickly switch over to Forex Factory just to highlight some of the key events, economic events to look out for this week. Okay, so Monday we don't have anything much. Tuesday, okay, Samuel, there's a request for US dollar franc. Okay, we'll quickly look through that after I go through the calendar. Okay, so do take note of okay, so we have the Reserve Bank of Australia speaking on Tuesday 30th of May. So I'm on GMT time, so this is 11 p.m. GMT. So he's due to testify before the Senate Economics Committee. So I'm not sure whether he'll be covering monetary policy during this during his speech. So do take note of this event. If he does decide to cover or highlight monetary policy and inflation, so it is likely to have an impact on the Aussie dollar as well. And of course, we have on Wednesday 31st May 1:30 a.m. we have CPI data coming out of Australia as well. So if you look at the historical chart, these are okay. Do note that these levels are on a quarterly basis. So inflation has been falling. Headline inflation has been falling continuously in Australia. We need to see whether the core readings are falling as sharply as well. So do take note, there's a couple of key events for the Aussie dollar coming out this week. And we have Canadian GDP data. We also have, okay, JOLTS job openings. Okay, this will be key for US as well, right? So higher job openings translates to a stronger labor market, right? It means the US labor market is robust, is resilient, and this would be positive for the US dollar. Conversely, if you see job openings continue to trend lower, then this would signal that the US labor market may be finally softening, right? But so then this is negative for the US dollar. So the combination of the JOLTS job openings together with the weekly employment claims that come up on the next day at 12:30 p.m. GMT on 1st of June. These two data points will be closely watched as it gives us a good idea of where the US job market is in terms of resilience, in terms of job openings, and also in terms of unemployment claims and benefits. So we also have, of course, ADP data out at 12:15 p.m. On June 1st, and of course after that on June 2nd we have non-farm payroll. So the main we have a lot of jobs related data coming out this week from the US, and we have inflation data coming out of Australia. All right, so this is what we have on the economic calendar for this week, so do take note of that. And also stronger job market or resilient job market or labor market for the US would translate into higher dollar as well. So this is potentially another tailwind for the price of gold as well, because if this data towards the end of the week comes in stronger than expected, it is quite likely bond yields will rise, the value of the dollar will rise, which means dollar index also is going to push up, your currency pairs are going to drop, and also gold prices are likely to pull back further as well. Okay, so let's just look at dollar franc before we sign off today. So where's dollar franc? Sorry. All right, okay, Samuel. Okay, here we have dollar franc. So similarly, as we've seen very significant demand for the US dollar over the last 3 weeks, that is why we see dollar franc pushing higher, rebounding, forming a bottom at about dot 8830 before breaking through what was the first resistance at 8980, and now we are just hovering below the next resistance level. So this overlap resistance level has been formed since November of 2021. You can see price reacting of it, acting as a relatively strong support back then. And then when it pulled back finally in this year of 2023, you can see price react of it on 3 instances, right? Or 2 instances. So it acted as a support again before breaking higher, then finding support again in middle of March, and then of course before finally breaking through here. So then it's acted as a resistance in April, and now potentially it's acting as the next resistance level as well. So do take note that the level of 90.88 is the next significant resistance level for dollar franc. And if the dollar continues to be very strongly bid up this week, dollar franc could likely break through this level as well. And also do take note what was previously an ascending resistance trend line. Price has also broken through this level as well, and now this area is now a major support area for dollar franc. So the level of 0.9 is a significant support area for dollar franc. So yeah, so do take note of the value of the direction of bond yields as well, because we have it's a period where bond yields are rising, the US dollar is rising as well. We can see, and we can expect dollar franc to push out and finally break through this resistance level of 90.90. Okay, so yeah, okay, so I've just come to towards the end of today's webinar. Just to sum up some of the key data, so key news as well. Okay, so PCE data last week on Friday, which is the Fed's preferred measure for inflation, shows the core reading and the headline reading re-accelerating again. So this is a concern for central banks. We also saw positive news come out of the White House with regards to the US debt ceiling limit. So there's a tentative deal on the table, and hopefully that gets formalized. And because of that, I expect a lot of risk on sentiment in markets today. So Asia and Europe, the major indices in Asia and Europe are likely to open strongly today. US is closed for they're having a 3-day holiday weekend because today's Memorial Day, so US markets are closed, and equity markets for US will open tomorrow, and I think we can expect them to rise strongly as well. And also for the dollar index, what has been 3 consecutive weeks, strong weeks of demand, we see the dollar index running into some immediate resistance between 104.30 and 104.50. If the inflation data, last week's inflation data, continues to push dollar higher, then we could see it break through this area and make a move towards the first resistance. And also, as we mentioned, right, we have labor market data coming up towards the second half of the week. So if all those data points like the JOLTS, job openings, weekly employment claims, ADP data, and non-farm payrolls come in stronger than expected, it signals a very robust and resilient labor market in the US, which is likely to fuel demand for US dollars again as the end of the week. So there may be pullbacks in the dollar index as we start off the week, but I think as we get closer towards the second half of the week and the data suggests that the labor market is still strong, we may see stronger demand for US dollar picking up towards the end of the week as well. And then in terms of resistance levels, it could potentially break out towards 104.60, 104.70 as well. Alright, Ahmad, okay, I just squeeze in the last one. There's a request for the Kiwi. Right, Kiwi has been tanking significantly over the last few days, especially last week, despite the Reserve Bank of New Zealand raising interest rates. Right, they raised interest rates again. I think bringing it up to 5.5% if I'm not mistaken. But because the statement also followed weak retail spending data coming out of New Zealand, retail data has been slowing down. Retail spending has been slowing down, so that shows the consumer is not spending, is starting to pull back or hold back on purchases. We also see the statement that was released during the press conference that stated that the outlook for the New Zealand economy is pretty is starting to look bleak. So they expect the economy to slow down. So despite the central bank raising interest rates, the combination of slower consumer spending plus the negative or pessimistic outlook on the economy is driving the Kiwi to fall lower, right? And we also had, of course, 3 consecutive weeks of strong demand for the US dollar. So all these factors have contributed in the Kiwi dollar falling. So we have the first intermediate support level at about .6027. So do take note of that. Okay, so if price were to break through this level, we generally don't see any major support level for the Kiwi dollar in terms of overlap support or Fibonacci retracement. We see the next one, which is pretty far down at about 57.58, right? So do take note, the Kiwi is very weak, and it could potentially find support first, and as you know, after such a big moves down, we may find support around this level here as traders take profits on their short positions, right? They start covering their shorts, which could potentially lead us to a relief rally situation before prices start pulling down again. Okay, all right. So yeah, so just to round up, yeah, so do watch out for the US labor market data that's coming up in the second half of the week, and yeah, do take note of any potential news surrounding the debt ceiling limit negotiations. Hopefully that deal can be formalized, which takes a lot of uncertainty out of the markets, and then we have less volatility, and we can expect equity markets to rise higher, right? The only concern is the core inflation data, which seems to be re-accelerating, which could potentially fuel demand for the US dollar again for the fourth consecutive week. All right. Okay, thank you everyone. I hope this has been a great session for all of you, and yeah, for all, if there are any American viewers, enjoy your Memorial Day, enjoy your 3-day weekend, and to the rest of us, have a good trading week, and yeah, catch you guys in the next webinar. All right, thank you everyone. Take care. Have a great week.